The Japanese yen is at its lowest in 32 years. In October, currency traders observed a shocking change that hadn't occurred since June 1990. The Japanese yen to US dollar exchange rate exceeded 150 to 1. Their currency crisis is far worse than you think, but how did it get to this? Now this crisis is layers like an onion, and despite the persistent efforts of Japanese officials to support the yen in the face of the surging dollar, it fell to its lowest level in 32 years. After authorities failed to stem an extended slump, $1 now buys 150 yen, up from 115 a year ago, for the first time since 1990. Isn't that crazy? The Japanese government spent as much as $2.8 trillion last month to boost the currency rate, but given that the Bank of Japan is still following its ultra-loose monetary policy, it seems to have had little lasting impact. Notice how this happens as other central banks, most notably the U.S. Federal Reserve, raise interest rates and stop pumping out large amounts of cheap money as part of their quantitative easing programs. This has caused foreign investors to swarm to the U.S. in search of bigger profits, driving up the dollar and causing sharp declines in other currencies. Because of its policy stance, which this week included emergency bond purchases to continue its aim of keeping rates low in financial markets, Japan has found itself particularly susceptible. To make things worse, the country's inflation, which is anticipated to exceed 2% next year and is an uncommon event in an economy that spent decades fighting deflation, is being exacerbated by the weakened yen's impact on import prices. As average citizens scratch their heads wondering when it all went to the pits, we've tried to gather more details for you. Stay tuned to find out. Okay, so Japan experienced its first recession since 2015 as the effects of the coronavirus further undermined the country's already fragile economy. In the first 3 months of the year, the third largest economy in the world behind the US and China contracted by an annualized rate of 3.4%. People literally stopped buying stuff after the Japanese government raised its consumption tax to 10% from 8% in October, which Prime Minister Shinzo Abe's administration claimed would help reduce the country's large national debt and compensate for the rising need for social services as the workforce ages. Then, only days later, a typhoon struck the main island of the nation, causing terrible damage and severely slowing down economic activity. But even before that, Japanese export figures had decreased consistently for the entire previous year due to a weakening in global demand and the effects of the US-China trade war. This year, the problem has simply gotten worse. The pandemic destroyed Japan's exports, forced them to cancel the Olympics, and then placed the country under a lockdown as it joined other countries in a race against time to stop the coronavirus. This is a country that runs on tourism, but according to the Japan National Tourism Organization, the number of tourists visiting Japan in March decreased by 93% from the same month last year to a little over 190,000. Then, consumer confidence dropped more in April than it did in the wake of either the 2008 financial crisis or the Fukushima nuclear accident in 2011. Only the first 20 days of the month saw an export decline of more than 1/5. So what do economists think? Well, they're predicting further deterioration of the already exceedingly bad economic conditions due to the lasting impact of the coronavirus. By the way, Japan has faced economic challenges, including slow growth and deflation, for much of the past 2 decades. These challenges have been referred to as the lost decades. One of the main factors contributing to Japan's economic challenges has been the country's aging population, which has led to a decline in the labor force and a decrease in domestic demand. Also, they faced persistent trade deficits and have had a high level of public debt. To address these challenges, the Japanese government has implemented various economic policies, including monetary easing, fiscal stimulus, and structural reforms. The Bank of Japan, Japan's central bank, has also implemented unconventional monetary policies such as negative interest rates and asset purchases in an effort to stimulate growth and combat deflation. You might be thinking why the yen falling to the dollar is an issue. Well, it's because Japan imports its food and energy, so the yen-dollar exchange rate is pretty significant. The yen's decline increases the financial strain on consumers and businesses. The change also lowers Japanese salaries compared to the dollar, which results in more Japanese leaving Japan in search of employment overseas and fewer foreigners coming to Japan. That is a dangerous trend for the Japanese economy, which has been struggling with significant labor shortages in the majority of its key industries as a result of population decline and a large-scale shift from rural to urban areas. Anyone who's following the global crisis will tell you that the sheer difference between Japanese and U.S. interest rates is what's caused the yen to decline. For instance, in an effort to combat the rising cost of living, the U.S. Federal Reserve has aggressively increased its key interest rate from 0.25% to 3.25% since March. What has Japan done? Nothing. A currency typically becomes more appealing to investors when its interest rates are higher, so there's a decline in demand for currencies from nations with lower interest rates. In fact, according to experts, the weak yen demonstrates how well those nations' finances are doing. In the past 3 decades, the Japanese economy has barely expanded. It also has the highest level of debt in the entire planet. Everything Japan purchases costs more as a result of the weak yen. The nation is severely reliant on imported gas and oil. Exchange rates and rising energy costs caused a 46% increase in the amount spent on imports last month. But hey, there is some good news for businesses. Japanese exporters' earnings abroad are far more valuable at home. This is noteworthy because exports make up around 15% of the nation's overall economic activity. However, over the past 10 years, the spending power of Japanese consumers has decreased by half. Today, 10,000 yen only buys you anything worth $67, as opposed to $132 10 years ago, given that the average salary in Japan has barely increased in the last 30 years. For the first time in 24 years, the Japanese government intervened in September by buying yen and selling dollars. The Bank of Japan hasn't resorted to forceful action to defend the yen, though, in large part because of a history of unsuccessful past interventions. The disadvantages of a weaker yen appear to outweigh the benefits this time around. Japan's very low inflation rate hasn't kept up with the growth in purchasing power, which results in a decline in real wages. The cost of products is growing, salaries aren't, and the yen now buys much less abroad than it once did. This trend, along with a weaker yen, results in a worse quality of life for average Japanese people. The Japanese government has so far provided 3.5 trillion yen in energy and food subsidies, a large fiscal commitment that won't endure forever but has mitigated the impact on households. In the past, when the yen declined, exports were stimulated, which aided in economic growth. This time, though, we are not seeing as much of this effect since Japanese industry is globalized as a result of the contracting Japanese market, so the weak yen is a mixed bag of pros and cons. We know that Japanese businesses benefit financially when their profits are reported in US dollars. However, the cost of imports for Japanese businesses is increasing. Simply put, Japan's export industry is doing better than its import sector, though not by as much as you might anticipate. Take the auto industry, for example. Due to difficulties getting semiconductors and other essential components as a result of ongoing COVID-19 supply chain challenges, the country's massive automobile industry has been unable to benefit from the exchange rate. The private sector will see very little activity for several years. As a result, the government will need to keep promoting economic activity. It might take years for the tourism industry, which has been a tiny but significant source of growth, to recover. And how can we forget businesses that had borrowed money in anticipation of the Olympics, like hotels and restaurants, who suddenly find themselves unable to pay back their debts? So yes, it might be a while yet before economic activity even comes close to what it was before. Do you think the worst of the Japanese currency collapse is behind us, or is there more to come? Let us know in the comments below, and make sure to watch this video next. See you around.